5 steps of property valuation. Welcome back to Real Estate TV once more. I'm Adnan Jalo. Are you ready to invest in your future and build wealth through real estate? Then you're in the right video, because I'll be describing the 5 steps that will provide you with the information necessary to say go or no go to a real estate investment. This procedure will allow you to determine the value of your property without conducting a physical inspection. You might not have the time to visit every property that you or your business is considering, but even if it's a 200 unit apartment complex, do not purchase a property without walking each unit and completing a thorough inspection. But use the steps to calculate the property's initial cash flow and arrive at an offer price. Let's dive into the video. Step 1. Verify property income. The annual income generated by a rental property is the property's income. Even if the seller states the property's income, you must confirm it. It is the most crucial factor to think about when purchasing investment property. Unlike your primary residence mortgage, which is secured by your personal wealth, rental investment property loans are typically secured by the property's capacity to generate revenue. Therefore, there are 3 types of income that you should know and consider when purchasing a property. 1. Actual income, which is the total income generated during the past 12 months. 2. Actual potential income, which is the total income generated in the previous 12 months if all of the property's units were 100% occupied and the owner had maximized all other income options. 3. Future potential income, which is the total income that could be generated at today's market rentals, assuming all of the units of property are 100% occupied and the owner had maximized all other prospects. Purchase real estate based on the actual income, always based on the current performance of the property and its income. This method of purchasing real estate reduces your mortgage and optimizes your profits. Therefore, you base your offer on the total income you obtained by calculating the actual income. The greatest part of this strategy is that it is simple to defend your offer during the negotiation process, since the figures are real. Now, step 2. Verify expenses. When it comes to verifying expenses, you cannot obtain the exact amount, but you can get a reasonable estimate. When you intend to buy a multi-unit building, regardless of whether you will employ a property management company or manage it yourself, you will need the following. Call them and say hello. Even if you will have to pay a consultation fee, it's worth it, because they will be able to assist you to estimate the expenses and cut expenses as well, as also what it will take to run the property. You must write the numbers on paper and analyze whether the cost of the necessary repairs will allow you to remain profitable. There's a difference between spending enough and overspending. Note, this is just calculations. However, once you visit, you might adjust some expenses. Step 3. Determine the net operating income. Net operating income, NOI, is income minus expenses. This is the crucial, because it will form the foundation of your offer. Ideally, you would like a large positive number. The larger, the better, but keep in mind that you will have not yet deducted the mortgage loan. Now, step 4. Determine the capitalization rate and the valuation. Capitalization rate, cap rate, is used to determine the property's value and offer price based on the new net operating income you found. To find the cap rate, you divide the net operating income the seller provided by the purchase price the seller is demanding. And to get the offer price valuation, you divide the new net operating income you found by the capitalization rate. This step helps in negotiating the offer price and to avoid overpaying for a property that will have a negative cash flow and will not cover the mortgage loan payment. No matter what, your offer should not exceed the offer price that you found. Step 5, last step, calculate the loan payment and your return on investment ROI. For the loan payment, simply search Google for mortgage payment calculator and you will have an answer in a couple of seconds. And for the cash flow profit, which is determined by deducting the annual mortgage loan payment from your net operating income, NOI. To determine whether the profit is good, you calculate the return on investment ROI. Now, to calculate cash on cash or return on investment, you divide the profit by the down payment and multiply by 100. Note, the average ROI for a solid deal begins above 9%. These are the 5 steps involved in property valuation prior to purchasing your home. Also, I suggest you read chapter 7 of the ABCs of Real Estate book to gain a thorough understanding of the calculations. Thanks for watching, and I hope this video has provided some helpful information. Please remember to subscribe, like, and looking forward to seeing you in the future videos.